We're going to get started. I think I've met mostly everyone. I'm Angie Schick. I'm the program manager for the BC Senior Ventures Competition. This is our final workshop of our spring series. A lot of you have been coming every week, so thanks for joining us all the way to the end. Hope it's been of value. And what you didn't know was that the subtitle of the workshop series was The Different Views of Vancouver. So today we have a really nice view thanks to Ernst and Young, and we've done a lot of events at Baskin Martin, who also has a different view. And we were at BCTIA the other day on Great Northern Way, so yes, when you join the competition, you're going to see lots of great views of the city. Hi, find a seat. I think there's a few here, and we'll grab a few more chairs.
Yeah, I was saying my bit, and then I'll go and get some more chairs.
And this is, okay, sounds good. A few more chairs. Yeah, so we are going to be doing about 2 more summer seminars, which we're just finalizing details on, so we'll send you details on that. You'll be welcome to those no matter what happens in the competition. But otherwise, today we're here to talk Financials 101 with Ernst & Young, and we talked about how to form this presentation so it would be of best value for you guys, and so we're open to your feedback and your questions throughout, and I'm looking forward to seeing them. So we've got a whole slew of speakers today. So I'm going to first pass it over to Richard Mockett. He's a board member for New Ventures BC, and he's also here to host us. So I'll pass it over to you.
Yeah, thanks, Angie. And good afternoon, everyone. We tried to present the seating so you wouldn't have to look out the window, because I know when you talk about financial information, sometimes it's easy to look out the window and daydream. So, so as Angie said, I lead our BC tech practice. I first started working in technology with a company called Infowave Software. They're a wireless software developer. I did investor relations, and I thought I was the best investor relations guy ever, because when I joined, the stock was about $1, and it went up to 70, and then about a year later it went back to $1. So I thought I had to get a different profession. So I joined EY, and I've worked with some of our biggest technology clients, HP, Amazon and Oracle, and some of the real stars in BC, like Crystal Decisions, PMC, Sierra, and some of the new sort of generation of stars like Elastic Path and Modify. So I'm delighted to welcome you here today. EY has actually was one of the founders of the New Ventures competition. We've sponsored the competition every year since then. And I'm actually off to the North Shore on Friday to meet Stephen Robinson, who was a winner of the competition last year. He's the CEO of Dark Vision, and sort of interested to see how he's getting on. He, as part of the competition, we sponsor money, but we also give away sort of services. So Stephen was very good at negotiating some good free services from us. So there to see how he's enjoyed working with us for the past year. At EY, our purpose is to build a better working world, and one of the ways we do that is to support entrepreneurs. So we have an Entrepreneur of the Year program, which celebrates entrepreneurs. We also support entrepreneurs through the Strategic Growth Forum. So we have forums around the world, in the US, China and Africa, Europe, where we help sort of grow great companies. And sort of more closer to home, I was explaining to one person what we do here is we had our global technology leader, who's based in San Francisco. He was up here for 3 days in Vancouver just last week, and from morning to night we met with a whole range of companies, and we had in this room a CEO for startups roundtable and dinner. And Jeff Liu, who's our global leader, he's been a McKinsey technology consultant and a leader. He's worked in investment banking in the Valley for 20 years. He worked with Alex Brown when they took Microsoft public, and still consults with a lot of the big technology companies and a lot of the next stage technology companies. So that's what we try and bring to sort of our clients and friends, that sort of insight from around the world that we see in EY, and bring that to Vancouver. And we ended up with an open mic session at the BCTA at the Hub, which went down very well. And Jeff, he met some very good, promising companies in Vancouver, and he's very well connected. And he's going to come up sort of 2 or 3 times a year to Vancouver, and that's sort of how we're trying to sort of support the entrepreneurs in shining more of a light on Vancouver, and especially strengthen those relationships between Vancouver and Silicon Valley. So today, looking forward to sort of getting to know you, and we'll keep it as informal and interactive as possible. We have 3 presenters, and they're going to sort of introduce themselves. But we're trying to, when we thought about how to structure the program, it's kind of difficult because everyone has different sort of financial literacy levels. So we've tried to make sure it appeals to most of you, and we've got a couple of slides on tax as well, and that's just really sort of the basics of the real stuff that you just need to know. But ask questions, make it interactive. We're here for however long you need us to be or want us to be around sort of after this. We've got, just in terms of logistics, we've got about an hour and 15 minutes of materials, including interaction, and we'll have some refreshments sent in here around 5 o'clock, and then we're here, as I said, as long as people want to be here. So that's the agenda, and looking forward to it. So thank you.
Hi everyone, my name is Wayne Hayden. Just a quick introduction from me before you hear from the other two. I am Australian, as you might have guessed. I've worked with Ernst & Young for the last 10 years. I'm now a senior manager in the assurance division, which is basically our audit and advisory division. I've moved from Adelaide to London and now here in Vancouver for the last 3 years. And although I spend the majority of my time in Vancouver, I am lucky enough to travel down to San Jose around every quarter to visit one of my clients down there. And I'm also the EY representative for the Vancouver Enterprise Forum that we're a current sponsor of. So that's me. Look forward to meeting you all after the event.
Hi everyone, I'm Matt Dunn. I'm also an accountant here at Ernst & Young. Just to give you a little bit of background of what I've done. Before joining professional services, I spent some time working with some startups here in Vancouver, and also spent some time in Palo Alto working for a startup called IMO, which was founded by George Henrik, who's one of the first 10 employees in Google. So I learned some stuff here. I'm going to be covering a bit portion of the financial statements and just telling you how financial statements really kind of tell the story of the business. But feel free to reach out to me and ask me questions about my experience in Palo Alto or my experience in Vancouver. Great.
Good afternoon, everyone. Last but not least, the token tax guy. So, I'm Basil Valley. I'm a senior tax manager here at EY. I specialize in Canadian tax planning for companies all the way from startup to international operations. My key focus is on tax planning for high net worth individuals, owner-managed companies, typically Canadian domestic, but also Canadian outbound. My strength is tax, so I love working with entrepreneurs and helping you understand the tax aspects so that you can go out and focus on what you do best. Some of my client base, it varies actually. I have a little bit of manufacturing. I've got a client that owns a group of restaurants. I've got real estate clients. And then within the technology space, I have a few clients as well, including one that's an app developer, as well as one that's a digital game publisher. So looking forward to sharing some practical tax insights for you in a bit. We'll kick it off with Wayne.
Great. Okay, welcome everyone again. If we could just jump ahead. Oh, my control now. So this is the agenda that we're going to walk you through today. Fairly high level, but obviously if you have questions or any observations as we go, please don't hesitate to jump in. Initially, I'm going to talk through the qualitative and quantitative aspects of what users and investors are interested in from a tech startup perspective, and then we're going to move on to more of the financial reporting side of things, which is obviously EY's expertise, before finally touching on a few taxation matters and obviously networking. So I thought we'd start out to better understand the objectives in the room, and it appears I had a quick scan down the invitee list beforehand. We had a very diverse group ranging from students, sponsors, small startups with an initial amount of funding to moderately successful startups with varying backgrounds. So what I thought we should do initially is just ask the group 2 quick questions. Don't know if you can read it from there, but basically the first one is, what life cycle stage is your company? And the second is, what is your main objective today? So there's 3 options up the top and 4 options down the bottom. I'll just give you 2 minutes to read them, and then we'll do a quick poll. And if anyone in the back would like me to read them out, just raise your hand. Okay, so the first question, what life cycle stage is your company in? And you may say, well, actually, none of the below, because I'm not actually in a company at the moment. So is there anyone in that situation? Can you raise your hand just so we get a feel for who's in the room? Okay. And in terms of the stage of your company's life cycle, are you fairly early in terms of employee numbers, small amount of funding, or if you're in that category, then please raise your hand. And if you have more than just a handful of employees, you actually have a product that's out there, is reasonably successful, you have more than just a small amount of financing, please raise your hand. Okay. And is there anyone in the third category with a large amount of financing and high reporting expectations? No? Okay, good. Okay. And obviously, what is your main objective of today? Is it to find out solutions that are specific to your company's needs? Obviously, if you have a few questions, feel free to ask them as we go along. Is it to understand how to calculate certain financial ratios and understand better how financial reporting should look like? Or is it just to network, meet new people and see if you can get further interest and investment into your own business? So are most people in all of the above category? Yeah. Okay. Anyone for A? No? Most people under B? Yeah. Or is it C? People just want to network and they're coming in because they're part of the competition and just want to be involved. Okay, I'm going to go with C, the majority of you. Okay, well, thank you for that. What I'd like to go into now is just an overview of some recent technology publications. So I don't know if any of you have had a chance to read these. I think both of them came out last week or the week before. The first one was in the New Yorker magazine, and the second one is actually a blog by a venture capitalist entrepreneur. So I do have, if you like, I can circulate these afterwards, but I would recommend taking a read. This is well worth it. So what I wanted to do quickly here today is just to provide an overview of each one and the key things that I took away out of each one. Starting with the first article, it was about venture capitalism and the story of a 26-year-old CEO for a company called Mixpanel. So he ventured to the Silicon Valley one day with a slide presentation that had 12 slides in it. And the interesting thing was that this slideshow was largely non-financial information. It was information about okay, here's the opportunity we have, here's the problem that exists in the market, here's the solution, here's who we think our competitors are, and here's our competitive advantage. There was a very small amount of financial information in the 12 slide deck, and those were more around sales projections, key performance indicators, and also marketing spend. So it was interesting to see that there was more on the storytelling side as opposed to hard financial information. This CEO ended up raising $62 million with this 12-slide presentation. And to put that into perspective, Hootsuite was the largest raising in 2014 within British Columbia, and that was also around the same amount, 65 million, but that was from 4 different VC firms. So I just wanted to share that with you, and one or two other interesting things about this article. The first being that I didn't realise that back in 2006, Yahoo actually offered Facebook $1 billion to buy the business. It's now worth over $218 billion, which is quite remarkable. And this article had me wondering whether or not the tech bubble was likely to burst again. So, and the reason behind that is because year-on-year growth for startups and companies with valuations of over $1 billion has actually gone up by 23. Like it's a huge increase, and it raises the question: well, is it about to burst again? And what this article teaches us is that, well, actually, if you look at now versus the year 2000, there's obviously been a lot of technological advancement, a lot of change. For example, in 2000 there were just over 50 million internet users, and now we have over 2 billion internet users. In 2000 we didn't have any smartphones, but now we have over 2 billion smartphones. So the market opportunity is definitely there. The environment has expanded beyond belief. So it's just one thing I thought I'd point out that was interesting from the article. There was actually an observation by the co-founder of Slack. I don't know if you've heard of Slack, but they were originally a gaming company that ended up having a valuation of almost nothing, reinvented themselves and became an office messaging app that is currently valued at around $2.8 billion. So the founder of Slack mentioned the fact that the quality of the VC firm you end up choosing to go with is sort of similar to where you went to high school. So it can actually guide you down the path you're taking. And in his instance, I mean, he was obviously guided somewhere that ended up earning him a fortune. But in other instances, there's certain VC shops out there that actually go and logo shop, for example, which means, well, there's a high-profile company and they jump in right at the end for a really low return, but obviously build up their profile and are able to list them on their cover page, on their CVs. So that's just one thing to be aware of. It also made me laugh and I'm not trying to throw venture capitalism under the bus by any means, but it's interesting to read in the article. It referred to venture capital as vulture capital, i.e. there's no free money. There is some sort of clause or term or covenant that exists in all of these arrangements, and they're designed that way so that investor that's providing the investment initially, who's taking that risk on your compelling story, is actually entitled to some sort of return or recovery if things go south. Hopefully they won't, but if things do, then it's just one thing to keep in mind, which is what the next article, which is actually a lot shorter. You can probably read the first one first while you still have a bit of energy. But the second one's sort of 2 to 3 pages, and it's all about having a great idea, having it valued at millions and billions on paper, but then everything falls away and the excitement falls away, and then all of a sudden the owner with that great idea walks away with nothing. But all of the investors and finances along the way still recover what they originally invested plus some. So it's all about the fact that the terms of an arrangement are as important, if not more important, than the actual overall valuation of the company. So with the mixed panel example in the first article, little financial information was effective in the pitch that was delivered. But I suppose at EY, what we're here to tell you is that financial information is actually very important. And obviously for most raisings, there is a lot of due diligence that has to occur behind the scenes. So the next slide is about value and the factors driving investment. So it's actually in order of a recent survey that EY did for investors in IPOs, and it was this order that was voted in terms of what was of most value to those investors. So we've already touched on compelling story and market opportunity. So in terms of cash flow and earnings ratios, we're going to cover cash flow and projections about cash flow in a little bit more detail with Nav later on. But there's also the cash flow management side, there's working capital management. And there are really simple things that companies do. For example, and I'm not sure how up to speed everyone is with this sort of mindset, but obviously the earlier you invoice after you perform the work or during the work being performed or even before, the higher probability you're going to be paid faster, quicker or on time. And then if you happen to have to chase what you've invoiced, then it's all about making sure that you know the exact contact within that customer and have that relationship so that it's easy to get paid as and when you need to. Inventory management is obviously key, and being in the tech space, not all of you would necessarily have inventory, but holding inventory levels to a state that enables high turnover, and only holding to levels that are equivalent to your order backlog or to the market demand that exists is very important. And also your accounts payable, your creditors. So obviously within reason, you can be strategic about timing of when you pay these creditors, which I'm sure you all are. So the earnings ratio of the earnings ratio, the price earnings ratio within this survey was seen to be the most important to investors. So price being the overall valuation of your company, and earnings being the earnings that you earn during a particular financial year. So if your company's valued at $5 million and you have 1,000 shares, then you end up with a certain value per share, and then if you divide that by, say you earned $100,000 in profit that year, you divide it by the same number of shares and you'll end up with a ratio. So if your price earnings ratio is between 1 to 2, that's probably pretty good. If it's below 1, it's really good, and if it's above 2, it's not that great. But it also depends on the industry you're in and obviously what your competitors are doing. So the tough part about the price earnings ratio, however, is that it's probably more applicable to public companies, and that's only because the valuation of a private company is much harder to do. And if you were to truly understand what the value of your company is, you probably need to engage a valuation expert. For the denominator of that equation, it's obviously the quality of your earnings that's important, that drives how integral that underlying ratio becomes. And we'll talk more about the quality and integrity of information later on today. So the corporate governance is lower down the list, as is infrastructure. From a small business perspective, corporate governance is going to not be as important until you actually start growing. But I mean, there's certain questions you'd ask yourself along the way. Have we got all the policies and procedures in place that we need to adhere to regulations and rules? Is there a code of conduct for employees? Do we have the right independent directors on board, and have their responsibilities been defined? Do they have the correct skill set? Are we aware of our environmental obligations? Those sort of things all are important for corporate governance. There's also processes and controls. Obviously, the larger you become, the more important that is. And then finally, infrastructure. It seems fairly basic, but just things around as you grow and forecast, like your financial information, cash flow forecast that Nav's going to walk us through later. It's not just the quantitative aspect, it's the qualitative. I mean, how are you going to actually physically meet that 20% revenue growth? Are you going to have enough warehouse room? If you grow by 20 employees, have you thought about where exactly that's going to be and how that's going to be structured? So you can kind of see how the ordering makes sense from a small startup business. It's all about cash flow early on, all about having a good story to get your market opportunity out there, and less so about the controls and the underlying backup behind that. So I'm just going to pause there before we move on any further into the financial reporting side of things. But I hope everyone found that somewhat interesting. Are there any questions?
What are some of the significant differences in financial reporting that you've identified between public companies and early stage private companies that investors are interested in?
So a public company is under a lot more scrutiny. They have a lot more stakeholders. Usually a public company would be under an accounting standard that is far more robust. And a private company, like if you had an audit or a review engagement done, you would probably be under the Canadian accounting standards for private enterprises, which is a little bit more lenient than what public companies have to go through. So, but in terms of what the users look at, they're actually looking at similar things. So, but it's not necessarily that available in a private set of financial statements, whereas in a public set of financial statements, you have to include things such as an MD&A, which has your results to date, but also what you expect going forward, things like your backlog, forecast revenue growth, and it shows what you have in place in order to do that. So it's just a bit more transparency, but ultimately the users of those statements are up to the same things.
Yeah, I think under both private and public, you want to tell the story, and that's what we're going to go through shortly about how best to tell that financial story. Private, you have a bit more flexibility because you can present to the user, i.e. the angel investor, exactly what you think is going to be important to them, whereas a public company, you have a lot more sort of required disclosure. But at the end of the day, you want to be able to tell the story of your business best through those numbers.
Yeah, I was just wondering if you guys deal with any companies that are crowdfunded. Like it seems to be such a popular thing these days, right? So, on product and things like that. Who knows? Like, I saw some guy get $10 million for some remote control cooler that will drive over to you. and deliver your beer to you, which is a great idea.
Yeah, it's awesome, isn't it? Yeah, well, I think crowdfunding is great. There's obviously a lot of different avenues, like a lot of websites globally out there. But for my particular portfolio, I suppose the owners have been lucky enough to actually not need to do that. But it's certainly something that's definitely out there. Like I've seen a lot of pictures and that sort of like in the Vancouver Enterprise Forum, for example. But in terms of the Vancouver client base that is taking advantage of crowdfunding, I'm not working with any of them personally. I don't know if you are, Richard.
There's some. I mean, there's some good examples there. I hosted a panel discussion about a year ago on crowdfunding at the Vancouver Enterprise Forum. So there's lots of avenues, but I think the concept is the same. Is that you've got a short period of time and a short attention span to use your story to the best of your ability to capture that source of financing. So the principles I'd say are the same.
I think, I don't know if you've heard of a company called Fidoki.com. I think they're somewhat Vancouver based. Yeah. They do more equity fundraising platform. Right. So it seems that there's been kind of like a little bit of a diversity, away from just product oriented crowdfunding.
Yeah, I mean you can do services, or you can pre-launch a product. Mike Volker, who I think maybe you guys have met, might do one of his seminars. He was one of the panel discussions on the thing. So yeah, it's kind of interesting how that's competing with the traditional angels. But you're right, it brings up a whole slew of different ways of financing a bunch of different products and services.
So are most of these guys just sort of like, not to say that they're fly by night, but just see the pants or whatever? Or are they doing all the due diligence, that a company is seeking more traditional investment activity?
There's less due diligence for sure. Because, you raise it through sort of going through an internet and contributing.
Right.
So there's a lot less. There's a lot less between you and
the regulatory
yeah.
is not a big deal.
No.
I have a follow-up question just on that subject there, because I think in provincial law in BC, Alberta, in the west here anyway, and also out east, has changed to sort of adapt to that kind of small group of investors that's outside of what a small
that's not true.
No?
In Canada, it's illegal to equity crowdfund. Period. No. In Canada, equity crowdfund.
They changed it. You can do provincial. The provincial just changed it 3 days ago.
3 days ago?
Yeah. There's new law. So there's no legal. They haven't put the.
So we're going to look into an equity crowdfunding.
That's
going to be one of our top workshops. There's an article about it. It's a pilot program.
Right.
So let's we should
their regulations
push on.
Yeah, we should.
It'd be good if we chatted for 3 hours.
It's not effective today.
You got to see how far it's been going for quite a while.
Yeah, we should move on to that.
That's up.
Thanks, Wayne. Unfortunately, the next part of the presentation isn't on the legalities of equity crowdfunding. But I'm going to go and cover really just what Wayne had touched upon and what Richard had mentioned, is really just telling a story with your numbers. And so I want to pose a question to you here is, what would you do if you and your startups, if you were given an extra $1 million in cash? Anyone? Well, I'm sure the answer would vary in different forms. Some of you would want to may have fundraised some of your startup by debt, and you want to pay down that debt. Some of you may want to invest in capital expenditures, more equipment. Some of you may have decided to hire more staff to increase sales. And what's interesting when we look at the financial statements,
would the right answer be to hire you guys?
I'm not supposed to guess that. So many businesses have the ability to collect extra cash that's just hidden in their balance sheet. One of the clearest examples of that is the ability to convert AR to cash as quickly as possible. So that's a process that can be done by having strict credit policies that allows you to have more flexible cash on hand to invest in other parts of the business. I just want to use that as a clear example of showing how, although it may be tough and time-consuming to make time and read and understand financial statements, but the financial statements really do tell and paint a picture of your business. And so here's a couple of things that we're going to go through during the next part of the presentation. And the first part we're going to cover is the historical financial statements. And that really essentially shows where has your company been. And the reason we look at the historical financial statements is it presents at a point of time, well, it presents how, well, the past, in some respect, is a good indication of looking at and predicting the future. And then we're going to cover and move on to the prospective financial statements. And that really is showing where is the company going? Where are you going in the next 3 to 5 years? And underlying those prospective financial statements, we're really going to look at the certain assumptions that you guys could potentially be making along with those projections. So hypothetically, if we're going to say in 3 years revenue is going to increase tenfold, well, why is that? Is that because you're currently negotiating with a major distributor and expect the deal to close at the end of the year? So it's always important that when we look at prospective financial information that we're looking at the assumptions that underlying those. And then to wrap that all up, we're going to look at the financial analysis and what does it all mean. And by doing that, I'll be kind of covering some key ratios as I go along to really kind of bring that financial information to life. So as I said, the first thing I really want to cover is the balance sheet. And so the balance sheet is a snapshot of a company's financial condition at a particular point in time. And it's important to note that it's a particular point in time, not over the entire year. And it's really composed of 3 key elements, and that's the assets, what a company owns. So do you own computers, hardware, servers? Some of the company's liabilities, what it owes. Do you have debt? Do you have bank loans? And the summary of the shareholder equity, which is generally the difference between those 2 accounts. And I really want to spend some time talking about the story elements and how I'm going to go through a couple of key accounts on the balance sheet and really highlight how those paint a picture of your business and how they really tell a story of where you could go. And the first thing I want to cover is cash. And there's always that slogan, cash is king. And that really is true at this stage of the companies that we're dealing with here, startups in particular. Have any of you guys calculated the burn rate? Chance? Perfect. If I may ask, what was the reason you did so?
When we go to seek some funding, we want to have an idea of how to answer the questions.
Yeah. No, absolutely. And so that's a great metric to use, and one of the key metrics that any investor is looking at is calculating. So hypothetically, if my business has about 500K in costs on a monthly basis and revenue of about 350K, so my burn rate on a net basis is about 150K. Well, that doesn't mean too much right now. But if I said to you I have $3 million in the bank sitting there right now, well, I'm only making the assumption that my burn rate is consistent at 150K. I only have 18 months before my cash runs out. And so those kind of numbers are really, really useful for investors and for your own analysis in going forward and understanding where you might need funding, and how much you would need to fund this. So it's really important to look at these considerations. And to go back to what I said earlier, it's really useful to keep in the back of your mind, what will you do with funds once you want to start them? You know, as I said, is it something that you would look at to increasing your headcount, to get more sales, or is it something you would make some capital expenditures? So these are the kind of things that we're looking at when we're looking at cash.
And just to add to that, I mean, one of the reasons, as people running businesses, it's important that you spend as much time in the business, but it's absolutely critical that you always know exactly, what your cash is, that you can answer questions about what your plans are. So what we try to do is break it down to the sort of the key components, because you should be able to talk about these, about your business, and understand what's in these accounts.
So go on to accounts payable. This is another account that really speaks volumes. I mean, what's sitting in the AP? I mean, how many payees do you have? And what's the amount there? How long is it taken to pay this amount off? These are the kind of questions that you should be able to answer and really describe to a potential investor of what's going on. A really important one is receivables. It's what's owed to you. And a really good way of looking at receivables is looking at your AR turnover ratio. So that's really how quickly are you transferring your AR to cash. If you're able to do that in a very quick period, say 15 days, then it could highlight that you have a great relationship with your revenue sources, so with your clients. And if it's taking longer, 90 days or longer, it may suggest that you don't have a great relationship with your clients, or it may suggest that you may need to reevaluate your credit policies to ensure that you're collecting cash as quickly as you possibly can.
Yeah, I think that one, that's a really good indicator of the quality of your revenue streams as well. So if your receivables are aging a long time, then that maybe indicates something that is not quite right with the products that you're selling to your customers, or there's other issues. And just on the AP, the other thing we see is people hate surprises, and with AP, you want to make sure that your AP is complete. So I've got a client, they're VC backed, and the VCs weren't very happy because you go to you present them a balance sheet and it shows this amount is how much you owe, and then they find some unrecorded liabilities where the vendor hasn't sent in the invoices, but they should be tracking those, and then suddenly the AP spikes the following month, and that's a surprise. So again, that's a good example of how you want to sort of instill confidence in people by knowing what's in your AP and making sure that it's complete.
Absolutely. And again, guys, if you guys have any questions, feel free to just chime in, ask anything. We're available at the session at the end to answer any questions you may have. So we want to capital assets. This may not be something that you may have or may not have, but it's something that you want to, that spells really volumes going forward, is what do you have in the capital assets? I mean, do you have servers, hardware, computers, do you own property? I mean, those are kind of things that as an investor you'd be looking at to see what's sitting on your balance sheet. And then lastly is equity. And equity is a really important one because you really want to know what kind of equity has been issued, the type of equity has been issued, who has claimed that equity, and really be able to clearly articulate your share capitalization. I believe, Richard, you had some comments on.
Well, just you want to, because if people are going to be investing in equity, they want to make sure, and the lawyers will help with this. I mean, they're going to ensure that the share capitalization table is complete. But you want to be able to explain succinctly, what equity you've given, what are the terms and conditions you've given that equity under, so that if someone does invest in your company, they know that their investment is comparable to the equity that's already been issued. I mean, overall, it's just having the crisper, the cleaner, the simpler you can present all of this information it instills confidence in those people who are going to invest in you. It does reflect on you as business owners.
How about patent with equity?
Yeah, that would form a part of your asset.
That's a very interesting question, because so if you've generated a patent, you can capitalise it on the balance sheet, but a lot of as an intangible asset, and I've had some clients, both public and private, that have capitalised those sort of soft intangible assets onto their balance sheet. But my view is that, and it comes down to preference and I guess stage of company, but most investors will discount what's on the balance sheet because that's an historical value. My recommendation is just expense it, but capture that value in the notes, describe the patterns, because the value is of the interesting value to the investor is the fair value, but you won't get that on your balance sheet. You get the amount that you've paid. So I don't get too hung up about whether you've got patents or other intangibles on your balance sheet, as long as you can categorise them properly in the income statement, which we'll come to. Does that answer your question? Yeah.
Any other questions regarding balance sheet?
Could you speak a little bit about disclosure of options?
Disclosure of options.
Sure, I can take that. Yes, I think options are a great example again around sort of that clarity. So, and I think the lawyers, work with the people at Faskins, they'll help you that. But you should be very crisp in recording the number of options you've granted, and you should be disclosing those options and again the terms of the options, because that's really important that for an investor that they want to know what the diluted share capitalisation is, not just the shares that have been issued. And you know, if you've got a private company that's still quite small, then I wouldn't get too hung up about the required disclosures under accounting. But again, it's very important that you're tracking those options that you've given to people, and you're disclosing those in a very clear manner. And were you also interested in the accounting for those, or just the disclosure?
Do you disclose options on the balance sheet then, so issued options? Or?
No, you disclose options in the notes to the financial statement. So it's very typical to have it in the notes, a description of the options that you've issued, you know, the strike price, the expiry, that sort of thing. And you know, under sort of accounting principles, you have to record an expense for those options, but again, for sort of an angel investor, they wouldn't particularly care about that expense in the income statement because it's non-cash. You know, they would evaluate, you know, much more the underlying terms and conditions of the options that are being granted.
If you're providing non-arm's length assets to the company while you're a startup, while you're starting off, in other words, assets that I myself own privately, and want to put that into some financial statements in front of some investors and attribute a value to it. So in other words, if I get investors in the company, I want to attribute a value to a shop and a set of equipment that's being used. But at the same time, I don't want to generate a liability for myself by providing an asset to myself.
Yeah, it's a very good question, and I mean, one of the fundamental principles of the financial statements that NAV's going through is there's a segregation between the company and the owner. So if it's a you know, a bona fide transfer of an asset you're prepared to give up and donate to the company, then the entry really is you create an asset, and then you would it's a contribution, so it'll be an equity contribution. If you have no expectation you're going to get that asset back if you've given it to the...
For instance, if it's a lease or a rent, so you're providing a facility that you own, and at this point I don't want to put it on the books at so much a month because I have to declare that as income to myself then from a company that has no revenue.
Yeah, so that's more of a you're giving services at no charge to your company.
Correct.
Right. So you know, depending on the type of lease, you know, it probably wouldn't hit the balance sheet because it'd have to meet certain criteria to meet the balance sheet. So what it would be is it would be an expense in the income statement. But if you were recording that at no charge, you would see an offset in the income statement. So you know, the company is having an expense, but you're sort of gifting that sort of service, and it would be a wash through the income statement. But I think the principle is really important that you're raising is what you don't want to do is you don't want to sort of contribute a whole bunch of assets on your balance sheet that aren't really assets. So on that lease thing, it's probably an operating lease, and an operating lease wouldn't get reflected on the financial statement. So only a capital lease. As to give you an example, if you're getting some free rent, then that would be through the income statement. But if you're leasing, say, a photocopier for 5 years, then that generally would be a capital asset because you're absorbing all of the value from that asset over the term of the lease. So, but in all of those non-arm's length transactions, the key there also is whatever the arrangement is to make sure you disclose that in the notes.
Again, feel free to reach out to us on any technical questions that you may have at the end of the presentation. So just wanted to mention one last point on this slide is really I mentioned earlier that looking at financial ratios. I think one of the key ones that we can apply to the balance sheet really is the debt to equity ratio. And it really is your total debt divided by your total equity. And by looking at that, I can quickly see how you finance your company. Are you financing your debt or financing your equity? Another one that's often used is the quick ratio, essentially your current assets divided by your current liabilities. And again, that will quickly show me, do you have enough funds on hand to cover your short-term debt? So I'm going to move on to the income statement now.
Maybe Paul, if there's any other questions on their balance sheet. Is that clear?
Actually, that follow-up question was, can you clarify between the quick ratio that you just highlighted and the working capital ratio? Or is that the same?
Well,
I think we just talked about the equity debt
ratio.
Yeah. And you have the current assets over current liabilities.
Yeah, so I was essentially talking about the quick ratio and how that's used to describe or illustrate how you can cover your current liabilities by your current assets. And generally speaking, you want that to be over 1 to show to your investors or showing any financer or bank that you can cover that portion.
And so that's the same as the working capital?
Yeah, sorry, that's the same as covered. Moving on to the income statement. So an income statement really shows the summary of a company's financial performance over a period of time, and that's typically a year. And some of the key elements of the income statement I'm just going to cover is revenue, cost of revenues, the operating expenses, and the net income. And so the revenue really highlights how much income have you generated during the year. And what's really interesting to see is how you generated this income in terms of, has it been steady? Has it been exponential? Has you grown? Is it been explosive growth between month 1 to month 12? Or really has your revenue started in month 8? Does it change exponentially? Does it go from month 4 being super high and then low in month 8? It's really interesting to note and understand the relationship of your revenue and how it's generated and what it looks like. I think Richard, you also have some comments about revenue recognition.
Yeah, obviously for revenue for a technology company, that's your key driver. That's what people are interested in. So I think again goes back to my point around really make sure you understand that revenue number. So for example, if you're selling software, you need to be able to explain. And you would say you've got 500,000 in revenue on your income statement. So you need to be able to explain how you've recognised that revenue. So have you sold it through 5 upfront perpetual licenses, for example, which gives you the 500,000? Or is it that you've given sort of software services and you're recognising that ratably, so once every month? And so it's really critical that you can explain in the financial information how that revenue number's been generated. Sure, some of you are probably following that lawsuit between Hewlett-Packard and Autonomy, and I find it fascinating that basically it seemed that HP bought Autonomy for about $8 billion, and 6 months later they recorded an impairment of $5 billion. And it seemed to come out from a difference in understanding of how Autonomy was recognising their revenue. HP understood that they were recognising their revenue on one hand, and Autonomy said, no, we're doing it this hand. And the reason why it's important is because HP had an expectation that they'll be generating a lot of annualised revenue on a go-forward basis. So really it's critical to be able to articulate how you're recognising it and when you're recognising revenue. So for example, if you're selling hardware, do you install that hardware, and if so, when do you install the hardware? When do you recognise the revenue? For example, I have some clients that they go to a client site and they install the hardware and they don't recognise the revenue until that installation is complete because it's a complex act. So they don't want to early recognise revenue that they may have to give back later on if it goes wrong. And then the other thing about revenue is you be confident in sort of the understanding the contractual terms and understanding if that could impact the accounting. So, for example, if you're a software company and there's a right of return that you give them the software and they want to try it out, they've got full return rights within 6 months, then probably you shouldn't recognise that revenue until those return rights have expired, and so you've got a track record of showing that customers don't use those, don't exercise those return rights. And again, why is this important? Is because it's going to impact your credibility. If you go in your income statement and record $500,000 of revenue, and then year 2 you've got a big reduction of your revenue because you've had to return a bunch of it, it doesn't help with your credibility. So it's really understanding the types of revenue streams, of the contracts, and being able to articulate those, again, sort of gives investors confidence that you're on top of this.
Is there a rule of thumb for calculating total customer value in terms of the predictability point you're talking about? Is it 100 customers you demonstrate that they're on board for 3 years? Is it 50? Is it 10?
Yeah, it's a good question. I think people look at it in different ways. So some people look at it as churn is the important metric. So you've got 50 customers, and of those 50% are renewing, because the key thing that we're seeing in the software industry, which has been around for a couple of years now, is that previously investors they like the upfront perpetual sale. So, and that's what the sort of likes of Oracle, and they would do anything they could to recognise that license sale up front. But now the markets are valuing the sort of cloud annuity revenue stream much more higher than the perpetual license model. So they look at things like the churn. They look at some of the things you were talking about. So I think it does vary, but I think if you have the basic data in the financial statements, then you can present it with the different metrics.
This might be off topic. For Series A, what is the appetite in the market? So do you have to have strong income? Like, are they really looking for strong revenue before they do Series A?
Yeah, I mean, to be honest, I'm probably not the I'm probably not qualified to answer. I can give you my views, because we had, as I said, on last Monday with our global technology lead, who had probably 10 or 12 CEOs of startup companies, and this is a personal view, and it's an anecdotal view, but there was a general feeling that seed money is okay in Vancouver. It's really that round A financing that is a lot more difficult, and then once you get past round A, then round B is that seemed okay. So there seemed, just again, this is anecdotal. This isn't EY's view, but there seemed to be a bit of a gap there. And again, to be quite frank, when we talked about with our global technology leader, we talked about some of the things that we may be able to do to try and shine a light on that. And we were down at the BCTA with Bill Tam, the president, and he's very interested in that as well, because obviously it's a critical stage for companies to get round A financing. So, but in terms of what they look for, it goes back to what Wayne talked about. It's the compelling story. It's do you have a product that meets a business need? Kind of one of the other interesting things we talked about with at the BCTA event is that investors seem to be more willing to invest at the very early stage in B2B rather than B2C, because B2C is so difficult to predict at an early stage. But it's really that story and what the revenue growth is producing. It doesn't have to be profitable, but I think you have to have some sort of story around the revenue. Unless you've got an amazing story that is going to change the world, and then it's you have to convince someone that's worth investing at that stage. I don't know if that helps.
Yeah, that's good.
Yeah.
Any other questions?
So it's 4:30, so I don't know how many slides are in your deck. So.
So just
this is the key stuff. Isn't
Yeah.
it?
So this is
we'll
really
probably number about 5 actually.
Yeah.
Okay, I have to say it. That's my
Thanks,
rule.
though. So moving on to the cost of revenues, the really key point here is being able to really understand what your costs are. Looking at your fixed costs, looking at your variable costs, and a good exercise that you guys can take into practice is benchmarking these to your competitors or to the industry. This might be a useful exercise in really understanding and be able to clearly articulate whether your costs are in line with what's going on around you. In terms of operating expenses, at this stage, usually you would see heavy expenses in some respect to sales and marketing, research and development, given that you're trying to increase sales and scale of your company. G&A is usually kept at a minimum for going forward. But one of the exercises that, again, you can use to understand your business better and really understand the story element of it is kind of looking at your cost per user acquisition. I mean, in some of your cases, it may be easy to compute if the data is readily available, or how many clients or users you're generating in a month period, and understanding how much you're spending on sales and marketing in that month too, to understand, am I spending too much on generating my users, or if you use different forms of sales and marketing, maybe one time you're using traditional means and sometimes you're using Google Ad Rep, maybe finding the most cost-efficient way of generating those users with the minimum amount of spent on sales and marketing. And lastly, I want to cover the net income. And this really kind of ties back to the cash portion that was mentioned on the balance sheet. And the reason why net income is really important is it shows the minimum amount it takes to be profitable for your company. And with that, in conjunction with the cash balance on the balance sheet, investors will be looking at how long you can survive and how much funding you would need going forward. So is there any other questions about the income statement that anyone has? Or again, feel free to, yes sir.
You're actually talking about the cost of sales.
Yeah.
So these days, for instance, I think Dropbox, if it's $10 revenue, I can raise and I will spend $8, $9 to get that revenue, but it can be very consistent, very heavy volume, attractive number. Is that going to be very popular these days? Convince those second stage investors and look at your growth model. The cost of sales is very high, almost at the same pace of the revenue growth, but the scale can be very significant. This is popular.
That's a great question. I mean, generally speaking, you'd want your margin to be as high as possible, right? Yeah, exactly. But that's a great question, and maybe I can ask some of the team here and provide some examples where that would be the case. But so I guess your question is, sir, is that a popular
in the current market?
In the current market,
what kind of thing will be popular? How long should be sustained? For example, doing this fashion for 1 year, that would be good story. After 1 year, significantly different. The market share is different. But after that 1 year, what do you expect to deliver? And then when should it change the model?
What's the lifetime value of the customer, though?
Exactly, but based on, this kind of strategy, for today, probably okay, but how long the investor can wait to see this strategy? And I just wanted to tell you what is gut feeling, and then when this strategy should be changed.
I think if you look at the sort of types of companies that get in the sky high valuations, they're the ones with the super high margins that are easily scalable. But one of the things that you may be able to articulate is would the margin increase over time as you're getting more efficient? You're keeping your costs flat, but can you increase the prices? As you get more market share.
Let's say I drop this 80% of cost of $1 revenue. Every $1 I have 80% of cost today, and then perhaps I have about 10% of, or maybe 8%, 5% of deduction from that 80% to 85%, and then 85 to 81%, then to 77%, something like this kind of pace to reduce for the next few years.
You should also consider your growth also. Because as you grow, your revenue is more and then your profit should be more.
Exactly. Yeah. Just from a costing part, really, that's probably.
Yeah, and I think if you can articulate how that margin is going to increase over time, and using these sort of these captions, and I think that could be a compelling story.
Thank you.
When you're forecasting your revenue, so obviously as a startup you might not have like customers yet. So when you're forecasting, you want to do a bottom up. So you start with however many customers, and then you have a growth ratio, right? So a lot of the times you want to have a graph that's like, we're making a lot of money. So are there any drawbacks to doing that, or is there are there kind of methods or strategies in order to have a more accurate estimate, or is that what investors are looking for, and that's a good way to do it?
And that's a great question, and I think traditionally everyone really wants to create kind of the hockey stick method of revenue, just to show an exponential increase. But I think, as I'm going to mention on some slides coming up when I'm talking about cash flow projections and revenue projections, is it's really important to make sure that your information is, first of all, consistent and credible. So yeah, that may look really pretty and it may look great, but you really want to make sure that you've really provided a lot of thought and weight behind those assumptions that you've made, and they really are credible. I mean, as you said, if you're going to say that your revenue is going to increase by tenfold in 3 years, it's really important to be able to articulate why is that the case. I mean, as I said earlier, is it because you're engaging with some big distributors that may increase that revenue exponentially, or are you expecting some kind of financing in time to allow you to achieve your business goals? You really need to have some weight behind that instead of just putting a pretty picture on the graph there. But we'll be talking about that on later slides. Any other questions you can see? Or again, feel free to reach out at the end. So the last thing we're going to talk about, this kind of summation of really looking at the balance sheet, is your cash flow statement. And this is really important because it shows you how you spent your cash during the year. And this is broken down into 3 components, and that's the operating activities. So how have you earned or lost money based on your day-to-day operations. And generally speaking, you would want to be able to articulate how, if this is a positive amount, how you've done so, and if it's a negative amount, what you plan to do to ensure that in future years this will not keep occurring. In terms of the investment activities, this shows, well, how much cash have you spent on capital expenditures? I mean, have you put some investment into hardware or capital upgrades that can, increase the productivity or increase the sales of your business? And then lastly, the financing activities. And this is usually a cash inflow. It's showing how you generating cash flow in your business. Are you going to the banks for financing? Are you, selling stock? So as a whole, this is a really important consideration to look at from a historical perspective, but more importantly for everyone in the room as a projection perspective, which we're going to be talking about now. So before I move on to perspective financial statements, does anyone have any questions regarding anything named in historical? So I think the key elements to really look at when we're looking at perspective financial statements, and the foundation really is the same in terms of the key accounts that we have gone through on the previous slides. But the real thing is again, and that kind of answers your question, is making sure that you have backup for the assumptions that you're going to be making in these respective statements. So if you're going to say in your balance sheet that your cash is going to double next year, why is that? I mean, are you currently talking to a bank and expect to gain a bank loan of a certain amount? So it's really important to back up these numbers up with some assumptions to really tell a story of where you're going. In terms of the income statement, again, it's really important to be consistent and credible with the financial information that you're going to present in your projections. So again, with the revenue example, to make sure that if you're saying revenue is going to increase by X amount, be able to back that up and really show how you intend that, or show how that's going to happen. And with the cash flow projection, I have the next slide here, which kind of gives you a nice template. Is similar to the income statement again, showing how the cash flow, how you spend your cash, and the assumptions behind those cash expenditures. I mean, have you chosen to spend more money in year 3 on making hardware upgrades, to increase your productivity, or to scale the business and increase sales? So really be able to articulate clearly the significant assumptions and judgments that you have made in those projections. And so here we have a classic example of a cash flow forecast. This is a kind of an excellent template that you guys could use in order to present clearly your financial information. Shows how the revenue, the cost of goods sold, all the way down into some of the key financial ratios that may be applicable to your analysis that the investor may want to see. I'd be more than happy to share this with anyone if they wanted one a copy to use as a template.
There's no losses.
We'll be kind. And so just to conclude this financial statement aspect, again, I just want to read out a few points, is to go through revenue projections. Again, make sure that when you're making these projections, to provide clear arguments to your assumptions. With the cash flow, again, clearly be able to articulate how you're going to spend your cash and why you're making those cash decisions. And lastly, an important thing to consider in preparing projections is really, if you're looking for investment down the line, is to really maybe potentially apply some exit timing. So when do you envision the business to potentially IPO? Would that be 3 or 4 or 5 years? And that's how useful that an investor might see in order to see his return on his investment. So now I'll be passing on to Basil to kind of talk about the tax considerations that come into play.
Thanks, Nat. Some really good financial information there, so we're changing gears a little bit to talk about tax. I feel like we could have a whole seminar about tax, but I'm not going to keep you guys. I know you want to get to your... What, am I the only one that's passionate about it? Come on. I'll keep you. We'll make sure we have enough time to enjoy beers and drinks. So I'm going to try and keep this to about 10 or 15 minutes. That doesn't mean I'm not encouraging questions. If by any means you have any questions about general stuff, please let me know. What I thought we would cover up at the end of this seminar is just talk about some of the incentives that are available to startups, and then talk a little bit about some of the basics when you're starting up with respect to corporate taxes, sales taxes, payroll, and then tax structuring. So first of all, there's the SHRED program, the SR&ED, Scientific Research and Experimental Development Program. So by no means am I a specialist in the SHRED program, but we have a whole department at EY that actually deals with business tax incentives, including SHRED. And I'm sure many, if not all of you, have heard of the SHRED program. But the gist of it is scientific research and experimental development. The federal government, the Department of Finance, and administered through the CRA, is out to support basic research, applied research, or experimental development. So basic research could be anything that you're going out there to do without any sort of end goal. Applied research is some sort of research that you're doing that has some sort of an end goal. And experimental development is really that kind of open bucket where you're trying to improve a process or improve a product or improve some sort of something, create some sort of innovation. It could be, also technological advancement that falls into SR&ED. Some examples I can give you from just my own client base and a couple of other contacts that I have is I've got a client that does beauty products. So they've innovated beauty products and they've claimed SR&ED on the research and the experimentation that they're doing with these beauty products. I've got a client that does a botanical beverage, and so they're quite big here in Vancouver, and they claim the SR&ED program, or claim tax credits under that program. I've got the digital media company, so the video game or digital game publishing company that also claims the SHRED credits, and they claim it in respect of the digital compression technology that they're using in some of the programming that they're doing. There's even one of our colleagues, one of my colleagues' clients, who actually claimed the SHRED program or the SHRED tax credit for an innovative process in baking bread. So it could apply to almost any sort of industry, not just technology. As I mentioned, it's administered by the Canada Revenue Agency. So you typically speak to someone that's specialist in SHRED. They'll tell you whether or not what you're doing qualifies for SHRED. You incur your costs during the year as you normally would in your startup or in your operations. At the end of the year, you file your tax return, and you get a percentage of your qualified expenditures back to you. So if you're what's called a Canadian-controlled private company, so a Canadian company that's private and operating in Canada, your tax credit's going to be 35% of your qualifying eligible expenditures. On your first $3 million, it's 35%. After the $3 million, it's 15%. And if you're any other corporation in Canada that's carrying on SHRED activities, your refundable portion, your tax credit portion is 15% on anything that you spend. So there's the 35% benefit or bonus
35% per year, or sorry, $3 million per year, or
per
$3
year.
million
That's right.
per
Per taxation year. So $3 million per taxation.
Before the gross up.
Pardon me?
Before the gross up.
before they go so.
Right. So and also there's a provincial component to that. So not only do you get the federal component of 35, but in BC there's a 10% component. So you're getting 45% in BC. Other provinces have their own provincial portions. For example, Alberta has a 10%, Ontario has a 10%, and other provinces also vary between 10 and 20%. The nice thing about the SR&ED tax credit for small companies, for CCPCs, Canadian Controlled Private Companies, is that there's a refundable portion. So it doesn't matter that you're not taxable in a year, you could be running losses, but if you have qualified expenditures of say $1 million, you're getting $350,000 back from the government in cash. So it's a very valuable expenditure, to the extent that there's actually companies out there that will go out and finance their SR&ED based on the expected refund that they're getting, because it creates a bit of a cash flow bridge. So that's the SR&ED program. Next is the Industrial Research Assistance Program, also known as IRAP. Again, most of you, if not all of you, already know about IRAP. The IRAP is a different type of a program in that it is not administered by Canada Revenue Agency or by the Department of Finance, the Government of Canada. It's actually administered by the National Research Council. And this is an innovation assistance program. So it's a financing program provided by IRAP, whereby if you qualify, you basically apply for the assistance, and then there will be a industrial technology advisory group that evaluates your application and then provides you with financing based on whether you qualify under their program or not. And the objective really there is to grow through development and commercialization of innovative technology-driven, new or improved products, services, or processes in Canada. Next, I'll talk about briefly the BC Interactive Digital Media Tax Credit. Again, if you're in the tech space, a lot of you have probably heard of this tax credit. And you'll also have heard that in the spring, the BC government announced that they're extending that tax credit to August of 2018. So again, these tend to be tentative or temporary tax credits that governments incentivize businesses to start. But the BC government has been finding that it's generating a lot of jobs, a lot of business, and a lot of buzz about the tech industry here in BC. And so they've extended the program. It was set to actually expire in 2015 in this year. And just on a side note, actually, one of my clients was instrumental in making sure that got extended another 3 years. So if you're a direct beneficiary of that, I can send them your thanks. But the BC Interactive Digital Media Tax Credit applies to taxable Canadian corporations that have a permanent establishment in British Columbia. So basically you have an office here in BC, and your principal business is to develop interactive digital media products. There aren't necessarily any content restrictions or no copyright requirements. This is also a tax credit it's administered by the provincial government here in BC, but again, you have to apply for it in advance, and then you'll receive the tax credit approval from the government. Whereas with the SR&ED program, the differentiating factor there is you incur your expenditures, you file at the end of the year, and then you'll get a refund of some sort. Question here, Chris?
How long do you have to be operating before you qualify?
For the Interactive Digital Media Credit, you can be a startup, so you don't have to be operating for very long. One caveat to that, though, is that once you've received your approval and within your taxation year, so let's say you have a December 31st, 2015 tax year, and you applied right now, if you received approval, let's say in the summer, you would have until 18 months after your taxation year to claim that tax credit. So there's just a bit of a time limit to be aware of. Question?
Is this more for gaming or anything that's interactive and digital? So I'm developing it's basically to help people with workflow as opposed to a game.
It can be interactive or digital. Actually, one of the things I was noting here is that it's an interactive digital media product that must educate, inform, or entertain, and present information in at least 2 of text, sound, or images. So it's pretty wide ranging. I'm pretty sure that your development will apply for this.
Can you combine it with SR&ED? Can you combine it with SR&ED if you're...
With your SR&ED?
Yeah.
You can. There is a little bit of overlap that you can combine the two, but there is still also requirements with respect to if you've received an incentive under the SR&ED program, you have to almost balance for that. But there are chances where you can overlap between the two.
Was there a percentage?
Yes, I was just about to touch on that. The tax credit, the interactive digital media tax credit, is basically a 17.5% tax credit, and it's 17.5% of the qualified labor that you spend in BC. So it's to the extent that you're paying a salary to a developer or paying salary to someone that is involved in the digital media development, then you get 17.5% of that back. The nice thing about that credit is actually it's also refundable to you. So again, you don't have to be a profitable company. The government of BC actually gives you money for spending that salary or that qualified labor here in BC. So that's interactive digital media credit. Now, the only caveat, the question earlier was can you also qualify for SHRED, or can you also claim for SHRED? For the BC component of SHRED, if you're already claiming the BC component of the SHRED, then you cannot claim the interactive digital media credit. So you kind of have to look at what's more beneficial. Is it the 10% of all qualifying expenditures under SHRED, or is it 17% or 17.5% of just the labor component under IBM? Next, I'm not going to touch on this one very much. It's the Small Business Venture Capital Tax Credit. Really what this tax credit is intended to support is investors that are going to make a capital or equity investment in a BC small business. So this is from the other perspective, not from the investee, the company itself. But the individual investor that invests in a small business venture capital company that's received approval from BC, that individual investor can get a 30% refundable tax credit on their personal tax credit, or their personal taxes payable in BC. And it's an annual maximum of $60,000 of investment. So, to the extent that you're going out there and looking for venture financing, you may want to consider obtaining this venture capital status for your company so that you can attract small business investments into your company. A couple more credits that are not covered on the slides, but I thought I'd mention them anyways. The Canada Media Fund. Again, the Canada Media Fund is similar to the IRAP. It's not administered by the tax authorities. It's a separate department of the federal government. And their mandate is it's similar to IRAP, but Canada Media Fund, you can apply through two separate streams. One is called the experimental stream, where you're dealing with digital media type products or digital media type projects. And the other is called the convergent stream, and the convergent stream relates to convergent television and media content. So Canada Media Fund, feel free to Google it to read more about it. And then last, of course, as you probably already know, BC is a big supporter of the film and tax industry. So we have BC Film and Television Tax Credits. There are several sub-credits within that. There's a production services credit. There's a basic incentive for film and tax. There's a regional incentive. There are distance-based credits based on where you're filming in BC. And then there's also the more relevant one, which is digital animation and visual effects, the DAVE credit. So these are certain other tax credits administered by the province of BC that you may or may not be able to qualify for. So that's the first half. Next, we'll get into the second piece of it, talking about appropriately structuring income tax considerations for startups, sales and provincial taxes. We'll touch a little bit on payroll. Starting off with the corporate income tax. As I mentioned, I used that fancy little phrase earlier, CCPC, Canadian Controlled Private Corporation. To the extent that you're a private company, you're incorporated in Canada, you're a resident of Canada, and you control the company and you're carrying on an active business, you're considered a Canadian Controlled Private Company or corporation. CCPCs will be subject to a corporate tax rate in BC of 13.5%. That's on your first $500,000 of your taxable income, so your net income calculated for tax purposes. And then it's 26% on everything over and above the $500,000. If you're a non-CCPC, so if you're any other private corporation or if you're a public corporation, your BC tax rate, your corporate tax rate is just a flat 26%. So where you want to be, I guess, more cognizant there is if you've got venture capitalists that own a stake in your business, that are a majority stake, and that might be non-resident, you'd automatically not be considered a CCPC and be subject to the higher rate right away. So that's some of the planning that that we try to take advantage of to make sure that companies are maintaining their CCPC status, especially in the startup phase, because you've got that nice low 13.5% overall tax rate. Another side note actually is the federal government, when they came out with the 2015 budget towards the end of April, announced that they're reducing the small business rate for the federal portion. So right now, when I said 13.5%, 11% is federal, and then 2.5% is BC. That 11% federal is scheduled to go down 0.5% per year over the next 4 years, down to 9%. So if all stays the same, we're going to be sitting at an 11.5% small business rate, which is pretty nice.
Can I ask a cross-border tax question?
I can try, sure.
So, have a salesperson in the U.S., an independent agent, have sales coming out of the U.S. Do I have to file any sort of U.S. tax document? I mean, there's some, so, I think the wording was if the revenue is associated with the agent, then there's some...
There's what's called nexus in the U.S. It's a little bit beyond the scope of this, but I'll try and answer it in 10 seconds or less.
Before we get to next topic,
Yeah, it might be a little bit beyond the scope, but I'll answer it in 10 seconds. If you're basically doing business across the border, a whole bunch of complexity, especially in the U.S., what happens is if you're creating what's called a nexus, then you might have to file a tax return there. Depending on how much activity you have there, it might be simply filing a return to the U.S. that claiming treaty exemption from your profits that are earned there, or it might be as much as having to actually report income there and pay taxes.
And the definition of nexus is having an office or feet on the ground?
You might have you might have an office, you might have an independent agent there, you might be generating some sort of sales in the state. Yeah, so it's definitely worthwhile to look into that. So corporate taxes, that's your rates. Your filing deadlines, if you're a CCPC again, your filing deadline to file your corporate tax return is 6 months after your year end. Okay? Your deadline to pay your taxes if you're a CCPC, sorry, for every corporation it's 6 months after the year end. To pay your taxes, your deadline is 3 months after the year end to pay your taxes. If you're a non-CCPC, it's 2 months after the year end to pay your taxes.
Facebook, do you have to file tax returns whether you're making money or not?
That's a good question. I get that a lot. If you're a startup company and you're in the loss space, you still want to file a corporate tax return. You're still obligated to file one. However, there's really no penalty for late filing one because your late filing penalties are going to get calculated based on your taxes only. So if you're in a loss position, don't drag it on, 2, 3, 4, 5 years and do a catch-up. Try and be a little bit prudent, but there's not necessarily going to be a penalty.
I wasn't sure if I heard this correctly. For a BC corporation, you were saying you had to be a resident if you deemed under this Canadian payroll or BC tax.
So for BC companies, it's 13.5%.
The BC company, you don't have to be a resident to have a BC company.
Not necessarily. It's carrying on business in BC. So you could be a federally incorporated company, but because you're carrying on most of your business in BC, then you're subject to that 13.5%. Whereas you could be incorporated in Alberta and still be a small business corporation, but their rate is 14%.
In BC, there's no residency requirement for opening a BC corporation.
I'm not sure. Can you clarify? You mean just
the directors of the BC corporation don't have to be
BC corporation?
Yeah, what you have to be doing is carrying on business here, right? But your directors or who's actually the mind and management
but instead of paying
should also be here in
26%.
So what's the difference between being subject to the 13.5% and the 26%? So if you're subject to the 13.5%, you're a private company, you're resident in BC, you're carrying on business in BC, and your mind and management is here. Yeah,
if you want that.
If you want it.
Yeah. Okay. Otherwise, you're a non-private corporation. So you've got directors and you've got shareholders that control the company that are not resident here, that might be resident outside of Canada. If you're still within Canada, if you've got a venture capital out of Ontario, then you're still considered a CCPC, right? And you're still getting some sort of a small business rate, whether it's the Ontario rate or the BC rate, wherever you carry on business. If you've got
BC done by the shareholders are resident, or is it done by where the business is?
Where whoever is, it's both. It's where whoever is controlling the company, but also where the business is carried on, right? And so that's where the mix comes in. If you've got BC out of Ontario that owns your company, but you're carrying on business here, then you're subject to the rates here because you're carrying on business here. Because your permanent establishment is going to be based on where your revenues and your salaries are within each province across Canada.
So not so much for the shareholders. or shareholders?
That's going to depend on that. Where your shareholder is or who's controlling is going to depend on whether you're Canadian controlled or not. Okay, so it's two separate sort of concepts. Okay.
From the tax perspective, is there a difference to be incorporated on federal level or on BC?
That's a good question. I'm just checking my time to make sure we're okay. We're okay for another 5 to 10 minutes?
We've probably got about 5 minutes. They're going to bring the food and drinking, which I'll put towards the back there.
Do you want to break and then I'll continue? Huh? Do you want to break and I'll continue?
No, I think we'll finish, but they're going to bring it anyway. And then
sure.
Have 5 minutes, and then we're around, as I said, we're around for a bit afterwards.
Sure. Quick answer to your question would be, there's really no cost or benefit to incorporating federally versus incorporating in BC or any other province. Typically, you want to incorporate in the province that you're carrying out business. A lawyer would probably be better to answer the incorporation question. Okay, so we'll quickly wrap up the corporate income tax part. Got your filing deadlines. Selecting a year-end, you're free to select whatever year-end you want for your corporation. Typically what you want to do is pick a year-end that coincides with your slow period. So accounting firms, for example, our busiest time is typically April to June, right? So our year-end is going to be more in August and September. Retailers, the same thing. You don't want your year-end to be December 31, but you can pick any year-end you want. Registering for a business number. If you incorporate in BC, you automatically get registered for a business number with Canada Revenue Agency. The way your business number works is it's a 9-digit number followed by an RC0001. So you'll get that automatically when you register a company in BC. Moving on to sales tax. So sales taxes, you've got your GST, HST, and your PST. As you probably already know, GST is an end user tax. So if you're registered for GST, you collect it from your customers, and then any GST that you pay, you net it against the GST you collect, and you remit the net to the CRA. PST, on the other hand, is final tax for everybody, so businesses and consumers alike have to pay that. Your registration thresholds, if you're making sales of goods or services over $30,000, then you have to register for GST or HST. You can also voluntarily register if you're below that threshold. Once you voluntarily register, then you have to collect GST because now you're engaging with the government. So you may want to look at there's benefits and costs to whether or not you want to register early or not, and then start considering how you're going to track your GST. PST, on the other hand, the threshold is lower, $10,000. As soon as you have $10,000 of PST-able sales, you have to register. And you would register with the particular government in which you're making sales. So in BC, it's the Minister of Finance. I think there's only 2 other provinces that have PST.
10,000 per month or per?
That's a good question as well. Your PST and GST filing obligations could either be monthly, quarterly, or annually, depending on how much your sales are in a year. Or how much your annual sales are. Registering for GST. So once you've got your business number open with Canada Revenue Agency, it's pretty simple to get a GST account. It's form RC1. Alternatively, you pick up the phone, you call the CRA, and you just say, I want to register. And if you've got a business number, they'll register you for a GST account as well. And the way the accounts follow, again, is it's the same 9 digits, but then it's RT0001 for a GST account. So you have the same 9 digits when you open a business account with CRA, but you have a different RC for corporate income tax, you have RT for GST, and then you have RP for payroll. So that's a good segue into the payroll. Payroll is anyone that's going to pay employees. You've got to open up your payroll account with Canada Revenue Agency. Your payroll remittances are going to depend on how much you're paying, how much payroll you're paying, so how many employees that you have. Typically for a smaller business, it's going to be the 15th of the following month for the month before, but sometimes it could be as quick as 10 or 15 days after you run your payroll for the period. You've got your CPP and your EI obligations, of course. So employees, not only do you have to withhold your income tax on behalf of your employees and your CPP and EI, but you have to withhold an employer portion of CPP and EI up to a capped maximum. Usually it's around 50. Increases by inflation. It's around the 50,000 mark. A good tool that I can point you to is Canada Revenue Agency has payroll deductions online calculator, PDOC, that you can actually find online if you want to do your own payroll calculations. I would almost suggest that there's a lot of good payroll service providers out there that you're better off handing it off to someone. In fact, one of my good clients is Pay Savvy here out in Gastown. So a little informal plug for them is if you're looking for a payroll service provider, Pay Savvy is a good one. There's others like Ceridian and ADP, some of the big ones, but the online ones are actually really starting to gain a lot of traction. WCB is your WorkSafe BC, just making sure that whenever you start a company, pick up the phone and call them and make sure that you register your employees. It's basically an insurance premium that you pay on behalf of your employees in case they get injured on the job. Now I know you're thinking it's a desk job. What are they gonna, your insurance rates are gonna be pretty low if you've got people working behind desks. Finally, we'll touch into tax structure. So typically when you start off, you're going into either a proprietorship, corporation. Sometimes you'll go into a partnership or a joint venture, but your common structure is proprietorship or a corporation. In a typical startup format, you will also start as a proprietorship and then migrate into a corporation. So that's another thing to think about. We touched on, I think Faskins did a presentation on incorporating and legal aspects of that, so I won't touch into that very much. But typically what you see is when a startup incorporates, they'll make a nominal subscription for the shares, so say $10 or $100, and then the seed capital will go in by way of a shareholder loan. That's typically the most efficient way to fund the startup. Rather than paying $10,000 for the shares, you just pay a nominal amount for shares, and you bring the rest in by way of an interest-free shareholder loan. So you can do that. You can make an interest-free shareholder loan into the company. If you've got multiple shareholders, you want to consider whether you want to hold your shares individually into the company or whether you each want to have your own holding companies. Again, depending on how much more sophisticated the company gets, how many more other ventures you have going on, you may be able to benefit from using the holding company rather than owning the shares personally. And then finally, when you've got a corporation, your typical owner-manager remuneration strategy is you want to consider whether or not to pay dividends or salaries or what mix. Usually the rule of thumb I like to give people is, pay yourself a salary of about $50,000 to $60,000, basically whatever you need to kind of live on, and then anything over and above that you can pay yourself as a dividend, and that's usually a good strategy. And that's it. Any questions, or should we break for food?
I think, well, is it okay, because I know that we said we'll be finished by 5, but we're going to be around for sort of, an hour and a half, whatever you want. There's cold beer, there's soft drinks, and there's some food. But I just wanted to say good luck to everyone. Like, I know it's a competition, and I know there's a big process around that, and I really do wish you the best of luck, and I hope to see, can't see all of you on September the 21st, but I hope to see a good portion of you at the competition. So we're around for, as I said, for a while, and we've got cards, and if you have any follow-up questions, we'll be happy to sort of answer sort of your question or two. But we wish you all the best of luck, and thank you for coming to our office.